Okay, if you look at the process of independent reviews, at the moment the standard that we are using is ISRE 2400, and a read through that standard will show you that independent reviews is not the most complicated aspect. It really is just a form of assurance. It's not a very difficult thing to do. If you've done audits before, then you can do independent reviews. I'm going to give you a quick overview of the review process, just to give you an idea of what the Probe MMX process is that we follow in our approach. First of all, independent reviews also are a form of assurance. You provide assurance just like you would in an audit. It's just a lower level of assurance. So in order to provide that level of assurance, you are going to do less work. Now, the main difference between an independent review and an audit is, of course, in the opinion that is expressed. In fact, in a review, we don't talk about an opinion, we talk about a conclusion, a review conclusion. Where an audit opinion is, I am satisfied that the financial statements are fairly presented, a review conclusion would be in the negative. Nothing has come to my attention that has caused me to believe that the financial statements are not fairly presented. Audit is, I'm satisfied that the financial statements are fairly presented. A review is, nothing has come to my attention that has indicated that the financial statements are not fairly presented. Slightly different words, I'm paraphrasing. And to arrive at that conclusion, you need to do less work than in an audit. In an audit, you do substantive procedures, test of control, and risk assessment procedures. In a review, you simply do review, analytical review, and inquiry procedures. And the process is as follows. First of all, you still need to obtain knowledge of the business. In a review, it's just as important to obtain knowledge of the business as it would be in an audit. The difference is in the level of knowledge of the business. You can perhaps get away with less knowledge of the business or less in-depth knowledge of the business. And you obtain that knowledge of the business in a different way. In a review, as I've mentioned already, you're only going to do inquiry and analytical procedures. Those of you that know the auditing standards will know that in auditing standards we also include risk assessment procedures here. So you can see that there's already a difference between a review and an audit in that in a review you only do inquiry and analytical procedures in order to get knowledge of the business. So that's the first difference. How much knowledge of the business do you need to get? Well, that is determined by the objective of this process. The objective of obtaining knowledge of the business is simply to identify areas that are likely to be misstated. Again, please pay attention to the different terminology that we are using here. In an audit, you perform a risk assessment. In a review, you identify areas that are likely to be misstated. So it's a risk assessment as opposed to a process of identifying areas that are likely to be misstated. You can see there's a big difference there. And once you've identified areas that are likely to be misstated, what do you do on those areas? On those areas, you are then going to do further work. What is that further work? Not verification yet. You don't go to source documents yet. You still carry on with what you have been doing, but just on a more detailed level. So you still carry on with doing inquiry and you're still carry on with analytical procedures, but you now do it on a more focused level. Where previously your inquiry and analytical procedures were focused on identifying areas that are likely to be misstated, now you go a little bit more in depth in order to identify areas that may be misstated. Your focused inquiry will include inquiries about things like what accounting policies are the client is the client using? In this particular area that I've identified already that is likely to be misstated, is the client using specific accounting policies, and is it complying with the accounting policies? Were there journal entries that we need to know of, specifically straight before and after year end? Are there any specific suspicion of errors or even fraud come into this, specifically in this area that we've identified that is likely to be misstated? So these are the types of questions that you will ask when you go into focused inquiry and focused analytical procedures. And that we deal with in a separate section of Probe, which I will show you just now. But once you have done all those, or made all those inquiries and performed all those focused analytical procedures, you go into and you identify areas that may be misstated, then you need to do more work on those areas that may be misstated. The first port of call would be to give it back to the client. Give it back to the client and ask the client to either adjust it or convince you that that area is in fact not misstated. If the client can convince you with additional inquiries or additional documentation or additional proof, evidence, whatever the nature of that evidence is, then you might still conclude that nothing has come to your attention that that item may be misstated. If the client is does not prove that to you, or if the client does make an adjustment, then you need to perform additional procedures. Now, those additional procedures might actually include verification. This is where we get into almost the audit terminology, verification. We look at assertions. We might look at cut-off testing. We might look at physical inspection of assets to answer the previous question that we've had. Stock counts, external verification procedures. You might consider assertions, cut-off, valuation, existence, things like that. You might go back to those. So you can hear that when we get to this stage, the additional procedures, we are actually entering into the area of audit. If you get to that level where you've concluded that areas may be misstated, you actually might need to perform procedures that include audit procedures. So that is an overview of the probe review process. You can see it is a three-step process, but please don't see it as three steps that follow chronologically. We have found in practice that those steps, obtaining knowledge, working on areas that are likely to be misstated, then working on areas that may be misstated, we've found in practice that those three steps commonly happen at the same time, or sometimes you go backwards and forwards between steps. So let's say, for example, through your initial inquiries, you have found that sales are likely to be misstated. You then ask a few more questions about sales. You ask, what are the accounting policies? When is sales recognized? And the client says that the accounting policies are to recognize it in the following way, and it seems from your inquiries that that didn't happen. Then you might go and perform some focused analytical procedures to determine what happened. And if you're not happy, you go into additional inquiries and additional procedures, maybe do some cut-off testing, maybe even do a sample. And that we do because we've identified that sales are likely to be misstated. And then you go on to the next section and you do, let's say, for example, cost of sales, and you find you don't have the same problem. And in salaries, you have the same problem. So what I am trying to say is that you go backwards and forwards through this process, but the important thing to know is that in an independent review is only inquiry and analytical procedures. Once you've identified areas that are likely to be misstated, you might go deeper into it, and that might include things like audit procedures. But primarily, we start with inquiry and analytical procedures, and you're going to find that for a significant part of the financial statements, that is going to be all that you do. That is for the initial part of the review. At the end, when you do the finalization stage, you still have exactly the same principles as in an audit, just on a different level. We're still required to look at analytical review, subsequent events. Going concern is still important because your framework that you are using, be it IFRS or IFRS for SMEs, still needs the going concern concept to be applied. And if the going concern concept is not appropriate, well, then something has come to your attention that has caused you to believe that the financial statements may be misstated, and therefore you are going to have to do more work. So going concern is still applicable. Subsequent events, still applicable because your framework requires it. Evaluation of misstatements. Materiality is still applicable. Therefore, throughout this process, you're going to use the concept of materiality and you're going to have unadjusted differences. Therefore, at the end of the review, you're going to want to adjust those differences, either adjust them or at least consider them. Consider if materiality is still applicable. And then at the end, when it comes to reporting, your reporting is also similar to an audit in that you can have a disclaimed opinion, qualified opinion, conclusion. We use the word conclusion, as I've already mentioned. You're going to use a disclaimed conclusion, qualified conclusion, or an adverse conclusion in order to arrive at, to report to the stakeholders. That is the end of the 10-minute presentation. We will now keep the line open for the next 35 minutes for more questions. I can already see some questions. Let me just go through it and then we will answer it in the next 35 minutes. You are welcome to raise your questions. You can see on the screen. Thank you.